Good afternoon. It's Friday, May 15th. I'm Kent Kramer, Chief Investment Officer at Foster Group, and this is our special weekly market update. As you know, we've been continuing to put this weekly video together since the pandemic started, and every week it's our pleasure to bring you what we think are kind of some of the meaningful events of the week and hopefully a topic that's helpful as you think about investing going forward. Times like this can be hard for investors to go the course alone, and we just want you to know we're here to help. We have over 1,400 clients who we truly care for. It's our pleasure to help them with all aspects of their financial planning, especially in preparation for uncertain times like these. This week, we're going to look at something, our regular market performance, then also talk a little bit about quality growth and value. As far as news for the week economically, April CPI fell a little bit less than 1%. It's the second month in a row of deflation. Year over year, however, prices have still increased. If you think about the last 12 months, just a little bit. About 0.3%. Last week saw a continued increase in the number of people filing unemployment claims, with just under 3 million people filing new claims for the week ended May 8th. And then just this morning, we saw April retail sales numbers drop to a record of 16.4%. Some of these numbers were maybe a little bit higher or lower than what economists were predicting, but it's very hard in this period of time to know exactly what those numbers are going to be like from week to week. One of the major events this week saw Fed Chairman Powell giving some video testimony, actually. Lots of people were asking questions, wondering what he was going to say. He gave some pretty serious-minded comments just about the idea that the recovery may be a little bit more slowly than any of us would like. And that may mean it's necessary for both the Federal Reserve to do more and for the federal government to do more. And that debate continues in Washington, D.C. this week in terms of what those ongoing policies will look like in ways that are going to aid a stronger recovery as we come out of this coronavirus or COVID-19 crisis. In terms of equity markets and bond markets, major stock market indexes were down a little bit this week. There was some talk that sooner or later this was going to happen. The stock market would come to realize that maybe the economy wasn't going to recover quite as fast as what people would like. However, the stock market indexes are still in positive territory for the quarter. Bonds are relatively calm this week. Government yields remain relatively steady. You can see that on the chart here in the kind of goldish orange line. That represents the bond market for the week, doing what we all hope it does, stay steadily to marginally positive. And then you see what happened both in the US stock market and stocks outside the United States, down somewhere around 2 to 2.5% for the week. But again, still positive for the quarter. So here's the question that we get asked pretty regularly. What companies will do best coming out of the crisis? It's kind of one of those questions that says, hey, the way my portfolio is positioned now, should we be doing something different based on what we think might happen after this period of kind of crisis, unprecedented dislocation is over? And the question, I think, gets framed up sometimes by looking at the past. People will say, well, will the largest growth and technology companies continue to lead, or well, those companies that right now are selling at very, very high discounts to earnings, sales, and book value, will they make a comeback, so-called value stocks? If we look at kind of the rankings year to date, you can see why this question is so important. This chart just ranks different kinds of stocks in terms of their relative return, and I'm looking at the year-to-date picture today. But you can see in the green, you can see growth stocks at 11.2%, and you can see large cap growth stocks over there on the right at 9.6%. Those places were really the places you had to be to have any kind of positive returns year to date. And those numbers are kind of surprising, I think, for people to look at. There's one other measure in there called quality, also in that kind of green area. We're going to talk about that in a little bit. I also want to look at the negative performing locations on the grid here. You can see on the left, value stocks down 12.8%, small company stocks down 22.7%, so-called small caps. And then in the lower right-hand corner, if you combine small cap and small cap value, you see where there's really been some difficulty in negative returns in small cap value, down over 27% year to date. This was as of May 14th. So when we think about kind of those stocks and valuations, one of the questions is, well, should I continue to buy those stocks that have done well in the past, or in maybe the immediate past, like the large growth companies, or should we be looking for stocks that maybe haven't done as well, but are positioned to do well going forward? One way that people have measured that in the past has been looking at certain valuation measures. Which stocks are relatively expensive or which stocks are relatively cheap? Right now, if you look at ways to kind of divide the stock market, you could look at the Russell 1000 growth or the NASDAQ 100, and you would find primarily growth stocks. And when you go down to the valuation measures down below, what you'll see are those price earnings, price to book, price to sales. You'll see those numbers where the gray boxes are. Those are the numbers that represent the highest valuations. In other words, investors are willing to pay the most for the earnings of growth companies and NASDAQ 100 companies. They're valued relatively high. Then if you look over to the right, what you'll see is the Russell 3000, which is the broad market of US stocks. And then all the way to the right, you'll see the Russell 2000 value, which are small companies of kind of a value nature. And you can see that the lowest valuations of any are over there in that far right-hand column. If you look at the price to earnings, the price to book, how much people are willing to pay for earnings, for the book value, for the sales of small companies, they're paying far less for those values than they are over there in the Russell 1000 growth and NASDAQ 100, for instance. In the middle are two funds that take kind of a middle of the road approach or a different approach to how they think about growth. What they're trying to do is buy growth companies, but buy those that illustrate or have indicated that their earnings should continue. In other words, they've had kind of earnings continuity, their revenue has been good, their sales have been good, their revenues have been increasing, they're profitable companies. Hence the name high profitability, or the iShares fund is called a quality fund. And what you'll see when you look at those two funds is they own the same companies that are in the Russell 1000 growth and the NASDAQ 100, but they own them in different percentages. They're less concentrated into those high growth, but some of them high quality earnings names. Now, why is that important? Well, there's been a lot of studies recently that have come out trying to understand the difference between growth and value stocks and where we are in this kind of cycle of outperformance, underperformance, growth versus value. A company called AQR, which is an investment management research company, they have released a study here recently that shows that the spread, if you look at the kind of academic measures of the spread between growth and value companies, they are at all-time highs. You can see the current percentile, meaning at 100%, meaning in the price to book ratio or value spread, it's as wide as it has ever been. Price to sales at 83% percentile, and price to earnings trailing at its highest that it's ever been. The composite of these measures is the highest spread that things have ever been. And when you look at this chart, which kind of summarizes the price to book spread, you can see spikes where the spreads have been the widest. Looking back into the late 1990s, which was the dot-com era, those spreads got very wide. Growth stocks were very highly valued relative to value stocks. Then again, in 2007, 2008, growth stocks became very highly valued relative to value stocks. And if you look at where we are right now, growth stocks again are very highly valued relative to value. Matter of fact, that relative spread is as high as it's ever been. So we go back to our question, which stocks do I expect to perform better? Or which stocks do you expect to perform better coming out of this crisis? And you really have two choices. Do you expect this spread to narrow, to go back to where it's been historically, something called mean reversion, or do you expect the spread to continue? In other words, those growth stocks that have done significantly better, will they continue to do better going forward? It's kind of a conundrum for investors to consider. We can look at how this played out in terms of returns going to the past. Here you can see the end of the 1990s, the tech bubble, where growth really began to outperform value in the green, the blue above the green. And then we go to the next decade. Sure enough, value was the outperformer. Things began to revert back to that mean. Growth underperformed, value outperformed. Then we go back from 2010 to 2020, and kind of where we've been experiencing here in the last few years, you see growth again outperforming. So we have that spread that we talked about between growth stocks and value stocks. Now the question is, what's going to happen in the next decade? And that is an important question to consider. Will it be growth or value, or might it be something else? Remember in that chart we looked at just a little bit ago, we saw those two funds in the middle, the Dimensional Profitability Fund and the iShares Quality Earnings Fund. They represent an approach to growth where they try to buy growth companies that exhibit certain academic measures of profitability. And it turns out that research that's been going on really since the early 2000s, but most of the best work has been done really since 2013 by a guy named Robert Novi Marks. What they've discovered is if you look back in time, the companies that illustrate kind of this high profitability or quality earnings have actually outperformed both value and growth stocks. So it doesn't have to be just a growth or value. In other words, one or the other. What if we applied that profitability lens, if you will, to earnings to both growth and value stocks? At Foster Group, we believe that you can have a very diversified portfolio that consists of both growth, value, and profitable companies. And we think that that diversified approach offers investors a good chance to do well, regardless of what the next decade looks like, whether it's growth or value or something else. My quote for the week is something I heard from Charles Schwab recently. It says this: "We remain invested in optimism." And I really like that quote because I think it captures how investors should think about the future, how indeed we do think about the future if we are investors. Investors would have no reason to invest in stocks if they weren't somewhat optimistic about the future of the economy and of companies to continue to produce income and good outcomes and growth. If companies aren't going to do that, there's very little reason for us to invest in them because our expected return in the future would not be so positive. While the immediate future may look uncertain and difficult, I think for most investors, myself included, what I choose to do is to remain a long-term optimist because I believe that companies will do everything they can to be profitable, to increase their productivity, to find products and services that people want to buy and that we all want to consume. That's what drives an economy, our ability to see that happen in those companies. And we benefit when we're able to invest in those companies as they grow. I hope that you'll be optimistic looking forward, even though kind of for a time right now, we're looking into a lot of uncertainty in the near term. The long term, I think, gives us reason to be optimistic. That's all for our comments today. If you have any questions or things you'd like us to address in the future, you can contact us at these places. We're glad that you chose to join us, and we look forward to talking with you next week. Thank you.